You wait hours for the perfect setup. Finally, the price pushes past resistance and you buy in, only to watch the market instantly reverse. Half of all standard breakouts fail because they represent a temporary surge in volume that lacks structural support. Most traders enter these positions based on lower timeframe noise, unaware that they are providing the liquidity needed for larger orders to fill in the opposite direction. To solve this, we use candle range theory. This system filters out these false moves by requiring a specific structural alignment between a higher timeframe and a lower timeframe. Mastering this sequence allows you to identify when the market is setting a trap, so you can wait for the manipulation to finish before executing your trade. Step 1 is defining your timeframes. If you use mismatched charts, the range signals will be inconsistent and unreliable. This chart shows the required pairings. A monthly higher timeframe pairs with a daily entry chart. A daily timeframe pairs with the 1 hour, and a 4-hour pairs with the 15-minute. For this example, we will focus on the 1-hour chart for our higher timeframe and the 5-minute chart for our lower timeframe execution. Following these specific pairings ensures that the price action you see on the entry chart is actually reflective of the structural moves on the higher timeframe. On the 1-hour chart, locate the most recently completed candlestick. To define your range, draw a horizontal line at the absolute peak of the upper wick and another at the absolute bottom of the lower wick. These are your candle range high and candle range low. These two lines mark the boundaries for the next hour of trading. Until the price breaks one of these levels, the market is in a period of consolidation where no clear trade exists. Watch for the next 1-hour candle to push below the range low boundary. This move triggers sell-side liquidity, trapping breakout traders as the price pulls back. The resulting long wick confirms a liquidity sweep, not a trend. We label this the manipulation candle. Now draw a horizontal line across its highest point. Because the lower liquidity has been cleared and sellers are now trapped in losing positions, the path of least resistance is now toward the upside. With the higher timeframe bias confirmed, switch to the 5-minute chart to find your entry. That single 1-hour manipulation candle is actually composed of 12 5-minute candles, showing a clearer view of the volatility at the range boundary. Do not buy exactly as the price breaks above the manipulation candle's high to avoid secondary fluctuations. Wait for the price to break the line, pull back to touch it, and then show a bullish signal. This retest confirms support. Entering only on the retest ensures you are moving with the established momentum rather than guessing at the start of a breakout. Once the trade is live, you must place your stop loss to define your maximum risk for the position. Place your stop loss just below the lowest wick of the manipulation candle. This puts your exit point outside the zone where the liquidity sweep occurred. Your profit target depends on the primary trend. If the overall market is bullish, set your target at the original candle range high. If the trend is bearish, set your target at the previous candle's body close to exit before the trend resumes. Adjusting your target based on the trend keeps your expectations in line with the probable flow of price action. When these steps align, you see the price sweep liquidity, confirm support on a retest, and move toward your target with clear momentum. Explicitly pairing your timeframes removes the pressure to trade every minor fluctuation, focusing your attention on the moves that carry actual structural weight. By placing your stop loss behind the manipulation candle's wick, you ensure your risk is positioned in a zone the price has already tested and rejected. Candle range theory provides a repeatable process for identifying price traps, allowing you to enter the market only after the initial manipulation has been confirmed.